In Australia, property investors make millions every year but pay surprisingly little tax. Today, I'm going to share 7 powerful strategies they use, breaking down exactly how each one works and how much it can save you, and ranking them from our tier list from worst to best. For each strategy, I'll explain what it does, show you the real numbers behind it, and rate it based on how effective it is at reducing your tax bill. By the end of this video, you'll know exactly how the rich minimize their taxes through property, and more importantly, which strategies actually work in 2025. So let's get into it. Let's start with negative gearing. Probably the most talked about strategy in Australian property. Here's how it works. Your property makes a loss and the government lets you deduct that loss from your salary. Let me show you the real numbers behind it. Say you're making 100k at your job. Your investment property brings in 30k in rent, but costs you about 50k in expenses. Instead of paying taxes on that 100k, you only pay taxes on the 80k. At a 30% tax rate, that's 6k straight back in your pocket. Now this is a tier B+. While it's good for reducing your tax bill, you're still losing money at the end of the day. With interest rates where they are in 2025, you need to be really careful with this strategy. It only works if the property is growing in value faster than your losses. Next one up is depreciation. And this is where it gets interesting because you don't have to spend any money to claim it. The government lets you claim wear and tear on the property even though you haven't paid for it yet. On a new property worth 500k, you could be claiming up to 15k in depreciation per year. That's potentially $4,500 back in your pocket without spending a single cent. And here's what most people don't even know. Even older properties can have significant depreciation if they're being renovated. Now, this is a tier A. Essentially, it's free money on the table if you do it right. You just need a quality surveyor report which pays for itself in months. Number 3, capital gains tax minimization. This is how the ultra wealthy actually do it. Hold the property for more than 12 months and instantly halve your tax bill when you sell it. But here's the real kicker, they never sell. Instead, they refinance the property to pull out the equity. Here's a real life example. If you have a 500k property grow up to $1 million, you can refinance and pull out 300k tax-free. This is exactly how wealthy people access their gains without paying a single dime in taxes. Now, this is an S-tier strategy. No tax event if you never sell, and you can still access the profits. Moving on to number 4, the principal residence exemption. And this is like finding a cheat code in the tax system. You live in the property for a while, then rent it out. And you can even move out up to 6 years and still claim it as your main residence. This means 0 capital gains tax when you do sell. This is the most powerful strategy you can do, and it can work easily with most people's lifestyles. Number 5, strategic timing. And this is the one that most people miss completely. Smart investors don't just randomly sell their properties. They time their sales for the years where their income is lower or spread across tax years to minimize their tax. They might even time the property improvements to maximize the deduction in the high income years. Now, this is an A-tier strategy. It's solid, but requires careful planning and patience. And on to the next one, debt recycling. This is how sophisticated investors turn their non-tax deductible home loan debt into tax-deductible debt. It's a complex strategy, but the tax savings are significant. Basically, you're converting your bad debt into good debt, and the ATO helps pay for it. Now, this is an A-tier strategy. It has massive tax benefits, but you need professional advice to structure it correctly. Last but not least, property development. This one's different because you're treated as a business rather than an investor. While you lose some tax benefits like the CGT discount, you gain others like being able to claim the development costs as a business expense. Now, this is a B-tier strategy, good for active investors but requires significant capital and expertise. Now, here's the truth, and this is something most people won't tell you. You need to combine these strategies for maximum effect. The ultra wealthy aren't just using one, they're using multiple strategies together. Let me give you a real life example. A smart investor buys a property, lives in it for a year, then rents it out during the 6-year rule. They then claim depreciation during the whole time. They also use debt recycling to buy more properties and never sell. They just refinance to access more equity. And because they combine these, their effective tax rate is often less than 15%. But here's a word of warning. Don't chase tax benefits at the expense of good investments. I've seen people lose hundreds of thousands of dollars buying terrible properties just because they had really good depreciation. First, focus on finding the good investment, then optimize the tax. Now, if you want to learn any more about these strategies, subscribe now because I'm going to make a detailed video on each one. Drop a comment below and tell me which strategy you're going to look into first. See you in the next one.